Hey everybody, mistakes that I made trading CMG options is what I'm going to share with you today. I'm Coach Brian from NetPicks, and today I'm going to share with you a mistake, or actually several, that I made trading CMG options. So back on February 3rd, CMG had an earnings announcement, and to say it was bad is an understatement. The company gave really weak guidance around future sales, same store growth in revenue and sales, and the stock was down on the news. What was interesting is it then whipsawed back, and it had been in this massive uptrend leading up right into earnings. And then after earnings were announced, you can see it right here on February 3rd, the stock recovered and then stayed a little bit higher. I assumed a floor was in place. And so what I did was I rolled out a vertical put spread. So I'm expecting that the stock to continue being flat or up. So I laid on a vertical put spread. Now, what's a vertical put spread? You sell a put close to the strike, right? So you're selecting a put where the strike price is very close to the existing stock price. And then you buy a put further away from the strike in order to give yourself some insurance. It's best for the flat markets. It's upward trending. You put money in your pocket right away. So this is what the options chain looked like. And, it's kind of interesting to see where the open interest is. If you were looking out 22 weeks, look on the February 20th. So I was doing this on February 5th. This is the February 20th options chain. So you're talking about 2 weeks out, and you can see there's some nice premiums and some really strong open interest. So, what would you have picked? Well, these were, 2 weeks out, good open interest. And what I did was I picked the 3750, which had massive open interest, and I covered it with the 35, right? And it took 2 weeks, and I was aiming to capture that theta, the decrease in options value as time expires. That was my thesis. So here's what the trade looked like in my account. I rolled it out, placed the trade, and you can see I got filled. I bought to open the 35, and I sold short the 3750, right? So this immediately put money in my pocket. I did it with five trades, 5 contracts, right? So there's 5 spreads, and I collected $158.34. I figured that was good enough for, 2 weeks. And my total risk, right, on this trade was only $217, right? So I've got $217, and my total exposure, if the entire thing moves against me, 217 times 5, about $1,000. So I'm collecting 158 at 105, right? So maybe a little aggressive there, but that's what I went with. And then here's what happened. So you can see arrow number 1 is where we put the trade on. And then arrow number 2, 4 days later, we sold, right? Now, this option had a bunch of time left in it, right? We had 2 weeks. Why did I sell just a handful of days later, right? Well, I sold for 216, and I was able to buy back for 128. That was my closing trade, the $128. So that gave me an $88 profit, or 40% in 4 days. Now, this is something key, right? You want to take your profits when you have them. When you see a big move and you can capture a gain in just a handful of days, take the win, lock it in, and put the money in your account. Now, I did the right thing as the stock moved lower below my strike for the next few days, right? So you can see it trending lower after I made the sale. And then what I ended up doing was I ended up holding on to the other option, right, which was struck at 35, which expired a few days later, right? So that expired worthless. So my overall profit on the trade after calculating in that expiration was a mere $30. In hindsight, I was lucky to get out with that small profit. I didn't quite see the gains that I wanted, right? And then I made another mistake, right? For some reason, Chipotle has my number right after the February 20 options expired. I wanted another shot. So this is what the options chain looked like on February 20th, right? All those other options were expiring. I was looking out about 3 weeks, and here you go. You can see the open interest, right? I looked 2 weeks out, and this is on March. So February 20th is when I was looking at this. I was looking at the March 6th put options. And as you see, the open interest is really weak. And I don't like to trade options that have really weak open interest. So then I rolled from the March 6th, I rolled out an additional 2 weeks to the March 20th, and you can see a lot better open interest and trading volume. That gives you some better pricing power, right? So you check those options out 4 weeks. Since that was higher, I went ahead and sold short the March 20th 35 put, right? And I collect 60 cents per contract. So at the time I placed this trade, I decided to go with a cash secured put, right? I figured, okay, I'm going to change it up a little bit. I sold 5 contracts and I put $296.66 in my pocket. Now, the capital required to do this was 5 contracts. Each contract is 100 shares. And remember, my strike price was $35. So you're talking $1,750. I'm sorry, $17,500 of security that you need to have there. And remember, the stock price was trading around 37. So you'd have to see it drop a few points. It'd have to drop about 2.5 points to get anywhere near my strike. And again, I was expecting the stock to stay flat or to rally. Then this is what happened. Yeah, the whole market slid. And you can see where I entered at this first price, and then the stock slid 15%. And then on the 18th is when I ended up exiting, right? So I ended up closing this trade, taking a loss, right? So I bought back the put options. I lost $716. Now, here's the mistakes I made. And this is why you always want to go back and look at your trades and think about what you're doing, right? First, I was forced to exit because I didn't buy enough time. I only went out a handful of weeks, right? And then I sat and sat and sat. And in reality, after seeing the market kind of continue to trend lower, what I should have done was exit with a few weeks left so I had time to get out, right? My other mistake was the trade type I picked. I picked a cash secured put. Had I done another vertical spread, my loss would have been much more limited, right? And the other thing is I rolled out a cash secured put while the trend in the overall market was down. If you look at the S&P 500 or you look at the Dow, those were both in a downtrend. And here I am rolling out a cash secured put that needs the market to be flat to up. So I made a mistake picking the wrong type of trade, right? The other thing I did, premium hunting. I was trying for a strike that was too close to the option in order to goose my returns. And like I said, I should have exited sooner. So it's important you always go back and you reevaluate what kind of trades you have. Now, I've got a whole bunch of other winning trades that went on that month. I wanted to share with you the occasional loser just so you see what you can learn from that. You learn from your mistakes. But you can get a bonus report from us on options. It's in the link below. We're using options to actively create regular income day in and day out. Again, click the link below in the description and you can download that option at any time. Have a great one.